Today, we're going to crack open a huge secret from Benjamin Graham's classic, The Intelligent Investor. It's a really simple shift in thinking that separates the real investors from the speculators. And it all boils down to one simple question.
I mean, it sounds kind of obvious, right? Almost silly. But believe it or not, this is a puzzle you face every single day in the stock market. The price you see flashing on the screen, it often has very little to do with what a company is actually worth. And here's where it gets real. Just picture two companies, basically identical. Same industry, same performance, same future. And yet, the market slaps a much, much higher price tag on one of them. Graham's entire philosophy is built on understanding that gap and using it to your advantage.
So before we can even think about analyzing a company, we have to get our heads in the right space. Graham built his whole system on two massive ideas, two golden rules that protect you from the market's biggest traps.
Okay, rule number one, and this is the big one, margin of safety. This is probably Graham's most important concept, period. Think of it like a massive cushion. You figure out what a business is truly worth, and then you just refuse to pay that price. You insist on getting a big discount. That discount is your buffer. It protects you if you're wrong, and it seriously boosts your returns if you're right. And this image, wow, it just nails the concept, doesn't it? See, investing without that margin of safety is like trying to cross a canyon on a tightrope. One little misstep, one gust of wind, and it's all over. But the margin of safety, that's the solid stone bridge. It gets you safely across because you bought in at a price that's so reasonable, it's pretty hard to get permanently hurt.
The second golden rule is all about knowing who you're dealing with. Graham came up with this amazing story about a business partner he called Mr. Market. And this guy, well, he's a little unstable. He's your partner, but he's totally driven by his emotions. The prices he screams at you every day have everything to do with his mood and almost nothing to do with the actual value of your business.
And let me tell you, his moods are wild. One day he's on top of the world, totally euphoric, offering you insane prices for your shares. The next, he's in a full-blown panic, begging you to take his shares off his hands for practically nothing. An intelligent investor, they just ignore the crazy highs and take full advantage of the panicky lows. You use his mood swings to find your bargains.
So we know Mr. Market is moody. How do we actually find the bargains he's throwing at us? Well, Graham gives us a clear process for this. It's all about becoming less of a gambler and more of an investment detective. So our detective work really boils down to asking a few key questions. How good is this company at actually making money? How does it stack up against its rivals? Is it strong enough to survive a downturn? Are the people in charge any good? And only then, at the very end, do we ask, what's the price? And this is what it looks like in practice. It's not about some secret Wall Street tip. It's about doing the homework. It's about digging through the reports, comparing the facts, and uncovering the real story. And what you find so often is that the super popular, overpriced company is full of hidden problems, while that overlooked, underpriced one is just quietly crushing it. And here it is, the actual framework. It's a super logical 7-step process. You start by figuring out who's in the race, and you gather the data from the past. Then, you analyze how good the business is and how solid its finances are before you even peek at the price tag. The very last steps are comparing the valuations and then, finally, making your decision.
All right, enough theory. Let's make this real. We're going to walk through a quick case study to see exactly how this framework works in the real world.
So, let's meet our contestants. On one side, we've got Company A. It's the popular kid, the one everyone's buzzing about. And on the other side, we have Company B. It's kind of the opposite, flies under the radar. Let's call it the boring bargain. Okay, let's put the numbers up on the screen, and whoa, a really interesting story starts to take shape here. Company A, the popular one, looks a tiny bit better on some quality stats, right? Like profit margin and debt. But look at the price. Company A's PE and PB ratios are way higher. That means you're paying a lot more for its business. Company B, on the other hand, is just cheaper. And hey, it even pays you a better dividend while you wait. So the choice becomes crystal clear, right? The market's chasing Company A, paying a premium for it.
But the intelligent investor's eyes go straight to company B. Why? Because you're getting almost the exact same quality of business for a much, much lower price. And that difference, that's your margin of safety. So when you pull it all together, you realize this isn't just a set of rules, it's a whole different way of thinking. Let's boil this all down to a few really powerful, timeless ideas that truly define what it means to be an intelligent investor. This is it. Maybe the most famous line in all of investing, and it's the heart of everything we've talked about. The market is obsessed with price. The intelligent investor is obsessed with value. They are not the same thing, not even close. And here's a little secret from Graham, one of his great paradoxes. A lot of the time, you'll find that the company trading for a cheaper price is also the one with the stronger, safer finances. The market loves to get excited about risky growth stories, and it totally overlooks the boring stability of a rock-solid company. But that financial strength, that's what ensures a company is still around tomorrow. And this might be the most important lesson of them all. I mean, think about it. We are drowning in information today. Finding data isn't the problem. The real challenge is having the emotional toughness to use that data rationally, to control your own fear and greed, and to just ignore the frantic screams of Mr. Market. And that really just leaves us with one last question, a question you have to ask yourself. Every single day, Mr. Market is going to be there, shouting at you, trying to suck you into his euphoria or his panic. The only thing that matters is this. Are you listening to his mood, or are you listening to the value of the business? Your answer to that question is everything.